In this video, I'm going to talk about the top 3 wealth killers that you should avoid and how by doing this, it could save you thousands over your lifetime. If you're new to this channel, I'm Matt. I've been a finance consultant for over 10 years. I now run my own company, and on this channel, I talk all things personal finance. So let's start with number 1, which is owning a vehicle. The second biggest household expenditure is transportation, only after housing. According to the American Automobile Association study, it revealed that the total cost to own and operate a new vehicle is over $12,000 per year. Cars are often linked to social status. As people earn more money, they often buy a more expensive car or use financing to own a car which is above their means. But if you buy a vehicle for $20,000 or $30,000, then the opportunity cost is using that money to invest and grow your wealth. For example, investing $20,000 in the S&P 500, assuming an average return of 7% over 30 years, that would mean you're missing out on over $150,000. If you need a vehicle to support your work and family life, whether it's driving the kids to activities after school or commuting to work, then there are a few ways to try to mitigate wealth erosion. Firstly, buy your vehicle in the middle of the depreciation curve. One of the biggest vehicle expenses is depreciation. Whenever you buy a brand new car and drive it for the first time, it's estimated that on average it immediately loses 10 to 15% of its value. It typically makes the most financial sense to buy a vehicle between 5 and 9 years old, as most of the depreciation has already been taken off its value. But this will depend on the make and model of the vehicle you're looking to buy. Secondly, shop around and compare for the lowest cost vehicle insurance, and do this every year to make sure you get the best price. A lot of people just renew with the same provider, but they may no longer be getting the best deal to go with. I always put in my diary a few weeks before the renewal date to remind me to look for the best vehicle insurance deal. And thirdly, if you have 2 vehicles currently, think about whether you could slim down to 1 vehicle for your family and how to minimize your fuel costs. For example, could you get an energy efficient vehicle? These 3 things can help you to mitigate the costs of vehicle ownership. The second wealth killer is high interest debt. It can be very difficult to grow your wealth with lots of high interest debt from things like credit cards, car loans, student loans. You can often feel like you're living paycheck to paycheck. As soon as your pay comes in, you pay your bills, you pay your credit card interest, and then there's nothing left for you to save and invest and grow your wealth. It can feel like a trap that's very difficult to get out of. 46% of households in the US have credit card debt, and the average interest rate on a credit card is 22%. The average American has $32,000 of debt non-mortgage related, and in the UK, credit card debt is at an all-time high too. The key is to not use debt to buy things that you can't pay back. Don't get in a position where you're forced to use debt to pay bills on time. There are loads of tempting times, whether it's sales in shops, the latest fashion trend, or the latest technology launch or phone upgrade. But unless I have the equivalent money in my bank, I don't buy it. I'm not saying don't use credit cards, because there can be a lot of benefits in doing so, such as protection on your purchases. But the key is only spending on credit if you have the money already to pay for the item. And the third wealth killer is not knowing when to invest and not taking into account inflation. Once you've managed to save a bit, one of the things that holds people back from growing their wealth is waiting for the perfect time to invest, and their money sitting there in low interest bank accounts while inflation gradually erodes its value. Looking back at data over a 28-year period from 1995 through to the end of 2022, if you had stayed fully invested in the market, in the S&P 500 for example, your compound annual growth rate would be 7.7%. That means you would have made 7.7% per year, and at that rate your money roughly doubles every 9 years. But if you had waited for the perfect moment to invest and kept your money in a bank account, and as a consequence missed the best 5 days over those 28 years, your returns dropped to 5.9%. If you miss the best 10 market days, then your returns fall to 4.7%. And if you miss the best 30 market days, then your returns fall to just 1.1%, 85% lower than if you had remained fully invested over that same time period. Unless you're retiring soon and need to preserve short-term wealth, if you can play the long game and invest, riding the ups and downs in the market, then you have a much better chance of growing your wealth. I'm not saying invest all your money, and I know it can be hard to save money to invest in the first place. The key is to build a buffer of money which you put in a high yield savings account and can cover any life financial emergencies such as long-term unemployment or illness, and then after this, to gradually put aside an amount of money to invest with a long-term mindset. If you look at some of the wealthiest people in the world, people like Elon Musk, Warren Buffett, their wealth is not based on having cash in the bank. It's based on the value of the assets they own. They've acquired assets such as property and businesses, and their wealth grows from the equity value of those assets increasing and also from the assets generating income. They then reinvest the income that they've received in buying more assets, and that cycle keeps compounding, growing the size and value of their assets and their wealth. So if you mitigate these three wealth killers, the costs of owning a vehicle, getting rid of high interest debt, and having a long-term mindset to investing, you'll put yourself in a much stronger position to be able to save, invest and grow your wealth. I hope this video has been helpful. Feel free to leave any questions in the comments and give the video a like and a subscribe, and I'll see you on the next video.